The first rule of investing, according to Warren Buffett, is never to invest in something you do not understand. A big percentage of cryptocurrency investors do not understand the technology behind this relatively new term. Bitcoin took the world by storm in 2017, and with it, altcoins exploded in popularity since then. Now, in 2021, institutional players are coming into the picture, creating cryptocurrency sections on their balance sheets, while more and more big companies started accepting cryptocurrency as a form of payment. But what is Bitcoin or blockchain? What is Ethereum? What is an altcoin? How to research these coins? And all of these questions you need to be able to answer before investing your hard-earned money in cryptocurrency. Everyone puts a disclaimer saying this is not a financial advice and do your own research, but very few people teach you how to do your own research and identify potential gems in the crypto space. This is Nick from Crypto Upscale, and I'm just a crypto enthusiast just like you. I don't trade crypto, I invest in crypto. I'm in it for the long haul, and I truly believe that crypto is like the internet back in the 90s. Still has a lot of room to grow. As I am by no means a financial advisor, please take this course for educational purposes only. I'm not an expert in cryptocurrency, but I do my research on a daily basis, and I created this course so that everyone starting from scratch will be able to catch up and start making their own decisions without blindly following YouTubers and influencers. In less than 2 hours, you will have a clear picture of blockchain, Bitcoin basics, you will be able to understand all the cryptocurrency acronyms you read online, you will learn how the fundamentals affect cryptocurrency, and most importantly, you will be able to identify potential investments based on your own research. Do you want to invest in high-risk, high-reward cryptocurrencies, or do you want to safely invest and get a 10% definite increase monthly? You can decide for yourself by using the techniques I'm going to teach you in this course. So let's get right into it. Hi, and welcome to the first video of cryptocurrency research and investing for beginners. This is Nick from Crypto Upscale, and in this video we are going to be discussing the flagship cryptocurrency, the king of cryptocurrencies, which is none other than the Bitcoin. Before we start, I hope you already found and downloaded the crypto cheat sheet where you have acronyms and jargon explained to you, so it's easier to follow this course or anything for that matter. If you didn't, make sure you download it and have a look. I'll wait. Okay, it's enough waiting. Let's get back to our video. Some interesting facts about Bitcoin. As of February 2021, the Bitcoin price is hovering around $48,000 to $59,000, which is insane considering it was worth few pennies 10 years ago. There are approximately 15,000 Bitcoin ATMs worldwide, which shows that people started adopting the cryptocurrency king. According to recent surveys, around 100 million people own Bitcoin or cryptocurrency, which means 1% of the entire population owns some cryptocurrency. These are all nice statistics, but what is Bitcoin really and why are people investing in it? To answer these questions, we need to understand what problem Bitcoin was created to resolve. So, back in time when gold and silver was the preferred currency, people exchanged gold and silver for goods or services. This was then automated to avoid logistics through paper currency, and this is where the banks came into the picture as a centralized authority. The only problem here is that paper currency is exactly that, paper. Every government or central authority is printing money when they are out of money. Too easy, right? Wrong. Gold is still valuable because it's scarce and you can't replicate it that easy. So what happens when you print all the money in the world whenever you feel like it? Currency is valuable because it's scarce and hard to replicate, which is not the case with our current system. When we continue printing money, the actual value of our paper currency drops. So when a bottle of milk doubles in price from $1 to $2 in just a year, it's not more expensive, it's just that $1 from last year is now worth $2, and this is what we call inflation. With the introduction of digital currency, debit and credit cards, Malicious actors could spend their money twice by manipulating the network and making it look like the money are still there. This is called the double spending problem. To resolve this, a central authority, aka the banks, keep a ledger of transactions to confirm or reject different transactions requests. But this solution has some limitations. First, it has a single point of failure and it's controlled by a central authority, a government or a group of people owning the banks. In 2008, a white paper was published on the internet for peer-to-peer payment system, aka Bitcoin, by the anonymous Satoshi Nakamoto. Until now, the identity of Satoshi remains a mystery, but in the white paper, Bitcoin seemed to solve the double spending problem. It was decentralized, it had a limited supply of 21 million Bitcoins, and it was hard to replicate. Sounds too good? Let me explain. Due to its nature, Bitcoin is built on the blockchain, which we will be discussing in the next video. The blockchain allows Bitcoin transactions to be confirmed by a group of nodes, making it near impossible for a malicious actor to double spend. In simple English, everyone can participate in the blockchain using a computer, aka a node, and every node is maintaining a copy of the ledger, which makes Bitcoin decentralized. These miners, as we call them, get Bitcoin rewards for confirming blockchain transactions and keeping a smooth operation of the blockchain. So, for someone to control the blockchain, they basically need to control more than 50% of the nodes participating in the blockchain network, which is nearly impossible in a widely adopted network. So, what about Bitcoin and its scarcity? Bitcoin was designed in such a way so that there will never be more than 21 million Bitcoins. With the current rates and halving every 4 years, we will reach these numbers by 2040. Given the fact that already around 1.5 million Bitcoins are lost forever due to their owners losing the passwords to access them, we can all agree that Bitcoin ticks the scarcity checkbox. So I hope you now have an idea on what is Bitcoin and why everyone wants to invest in it. In the next video, we are going to be discussing the blockchain basics, which will give you an even better understanding on how Bitcoin works. So stay tuned. Hi, and welcome to another video with Crypto Upscale. In the previous video, we discussed Bitcoin and its fundamentals and how it is creating a revolution in the world. In this video, we are going to be discussing blockchain, which is to the Bitcoin what the internet is to the email. So let's get to it. Blockchain is defined by a lot of websites and institutions as a digital ledger of transactions that is duplicated and distributed across the entire network of computer systems. A bit too complex, right? My definition of a blockchain is: blockchain is a decentralized way of validating transactions or contracts which is controlled by no one and everyone. Now that doesn't make a lot of sense, does it? Why we need a ledger to be digital or duplicated? And who owns these computers? Do these computers control the network? To answer these questions, we need to identify the issue that Bitcoin is solving by using the blockchain, which is none other than trust. Trust is the foundation of a currency. Trust that the same currency will continue to have value in the future. When someone creates a digital currency, what stops them from generating 1 million or 1 billion of that digital currency in the central database and then they release the currency? Blockchain is designed in such a way so that this would never happen. Each block contains some data, the hash of the block and the hash of the previous block. The data stored inside the block depend on the type of the blockchain. So let's take the Bitcoin blockchain as an example. The block would contain data information about the Bitcoin transaction, like who is sending the Bitcoin, to whom it is sent, and the amount of Bitcoin to be sent. A block also contains a hash. A hash value is basically a block's fingerprint. When the block is created in the first place, it calculates the hash value using the mathematical hash algorithm. Now, when a block is changed, this hash value is calculated and changed as well. Therefore, the hash value of the block makes it very easy to detect changes in a specific block. The last element of a block is the hash of the previous block, hence a chain of blocks. Now, if a malicious actor, let's say John, changes a specific block, this will make the following blocks invalid and we'll have to recalculate the hash of the next blocks as well. In today's world, computer can change a block hash and then recalculate the blocks in minutes. So, in addition to the security that hash values provide, blockchain introduced something called delayed proof of work. This is basically a mechanism that slows down the creation of a block to a predefined amount of time. In Bitcoin's case, this is 10 minutes. So, in our example, for John to tamper with the data of the block, it will take him 10 minutes to recalculate the hash value just for that block and then 10 more minutes for each invalid block. Lastly, the blockchain is decentralized. Instead of the blockchain being controlled by a central authority, it is using a peer-to-peer network. This means that a group of computers is basically controlling the blockchain and keeping a copy of the ledger as well, and that's why blockchain is defined as a distributed ledger. These computers are also known as nodes, and they are validating blockchain transactions in return for Bitcoin rewards. Now, let's see an example on how blockchain would work. James wants to send 1 Bitcoin to Maria. James sends 1 Bitcoin through the blockchain and a new block is created on the blockchain. This block is now in each node's ledger. Each node on the network verifies the block to make sure that the block was not tampered with. If everything checks out, then each node will add the new block on their blockchain. All the nodes now created what we call consensus, which is the agreement on which blocks are valid and which are not valid. I hope you have now a better understanding of how a blockchain works and why it can potentially be the future. Stay tuned, as in the next video we are going to jump into altcoins and how they might be the next big thing. Hi and welcome back to another video. This is Nick from CryptoUpscale, and in this video we will be discussing one of the most lucrative investment assets, the altcoins. An altcoin is basically a short version for alternative Bitcoin, which means any cryptocurrency that is not Bitcoin is an altcoin. The most famous altcoin is ETH, the currency for Ethereum network, which is the number 2 cryptocurrency by market capitalization, but a lot more altcoins are known, such as Cardano, Stellar Lumens, and Litecoin. Currently, there are around 8,000 altcoins in the market, and as you might have already guessed, around 90% of them will go to zero value in the long term, as it happened with a lot of altcoins back in 2017 altcoin season. Now, what is an altcoin season? An altcoin season is considered the season where out of the top 50 cryptocurrencies, more than 75% outperform Bitcoin. As altcoins are very volatile and can fluctuate in price with big percentage changes, investing in these altcoins is a great way to build life-changing wealth or get wrecked, as they say in the crypto world. The difference between wrecked and rich is up to you and doing your homework and the research before investing. Things like fundamentals, token allocation, legal research, and tokenomics are some of the factors that you should be researching before putting your money in an unknown token. Yeah, you can just buy whatever the influencers on Twitter and YouTube are telling you to buy, but you have to consider the probability that some of them might have an agenda of dumping on you just as the price increases. There are 3 types of altcoins which we will be discussing in the next video, but there are tens of altcoins categories depending on the industry of the altcoin. In 2021, categories like decentralized finance or DeFi and non-fungible tokens or NFTs are the ones that are currently going parabolic as of now. So, in the next section, we are going to be discussing the different tokenomic factors that impact the token's value, and at the end of the section, you can also find and download the investment checklist. So, let's get right into it. Hi, and welcome back to another video with Crypto Upscale. In this video, we are going to be discussing the different types of altcoins. Understanding the difference between altcoins can be beneficial for your research moving forward, as different economic factors apply to different types of altcoins. So let's get right into it. When it comes to altcoins, there are three different types. We have coins, tokens, and stablecoins. Let me explain on all three of them. Not all cryptocurrencies are coins. Coins are basically the cryptocurrency of their native blockchain. As you already may have heard, different blockchains are built based on the Bitcoin's blockchain by improving the initial network. Some examples of coins are Bitcoin, Ethereum, and Monero. All these cryptocurrencies have their own blockchain. Coins are usually used to pay for fees, buy other cryptocurrencies, and incentivize miners to continue validating the blockchain. On the other hand, tokens do not have their own blockchain. They usually reside in more than one blockchain, and they are basically cryptocurrencies of different projects with a unique use case in the real or digital world. Some examples of tokens are Stellar Lumens, RSR, and EasyFi. And finally, we have stablecoins. Stablecoins are basically cryptocurrencies that are tied to the value of an outside asset, such as the US dollar, and therefore they have minimized volatility. Some examples are Tether, TrueUSD, and USD Coin. Stablecoins can also be tied to commodities such as gold or silver. They can be used for payments or lending on the blockchain, trading currency instead of using fiat money, or even for powering decentralized applications. Stablecoins are preferred in comparison to fiat as they are faster, with lower fees, and they are borderless, meaning it doesn't matter which country you reside and what is your local currency rate. Learning to distinguish the difference between these three types of cryptocurrencies is the first step in identifying your next investment. In the next video, we are going to be jumping into market capitalization and token supply metrics and how to evaluate each token based on these metrics. So let's go right in. Hi, and welcome back to another video with Crypto Upscale. In the previous video, we talked about market capitalization and supply metrics, and in this video, we are going to be talking about allocation, distribution, and how cryptocurrencies are created. Cryptocurrencies can be created through a pre-mine process or through a fair launch. A fair launch is when a group of people start mining a coin or token as a community. In fair launch, there is no allocation or distribution since the network is open to the public since day one, and everyone willing can participate in the mining of the cryptocurrency. Allocation is only relevant to pre-mined coins or tokens. Pre-mined cryptocurrencies is when the team behind the cryptocurrency mints some of the cryptocurrency or all of them before the network is open to the public. They usually pre-sell these pre-mined coins or tokens to angel investors, partners, and other insiders of the team to very low prices in order to raise the funds needed to build the product. After the pre-sale or private sale is over, they sell the remaining through an initial coin offering or ICO. If you are like me, chances are you never had or will never have the chance to buy pre-sale coins or tokens. Pre-mined cryptocurrencies allocated to developers and early investors often result in more circulating supply percentage in many of the cryptocurrencies. Circulation supply percentage is the share of circulating supply in comparison with the total supply. For example, if the total supply is 100 million and the circulating supply is 10 million, it means that the circulating supply is only at 10% of the total supply. Big percentages of allocation and distribution outside of the public markets can limit the growth of a project if early investors start to sell their coins or tokens during a bull run. You can view the allocation and distribution of a cryptocurrency through the ICO details. ICO Drops is a website that you can check token allocations for past and upcoming ICOs. There are also crypto explorers where you can check the total distribution and allocation. You can use Etherscan for ERC20 tokens and BSC-Scan for Binance coins. In general, when you see wallets owning more than 10% of the coin or token's total supply, it might be a red flag for a potential sell-off if that owner wants to sell their holdings. Addresses with a small notepad next to them, such as this example, are smart contracts and not wallet addresses, so it's not one person owning this. When you are having trouble finding out the allocation and distribution of a coin or token, usually it's intentionally to hide how unequal the current distribution is. In these cases, I wouldn't go near those coins or tokens, but what do I know? So, let's take an example from Etherscan and see Dogecoin's allocation and distribution. From CoinGecko, we find the block explorer for this particular token and scroll down to the distribution tab. As you can see, a single address holds 36 billion Dogecoins, which is roughly 30% of the total circulating supply. In the case this wallet owner decides to start selling their Dogecoins, the price would start decreasing dramatically, so I would stay away for long-term investments on cryptocurrencies that have similar distribution. So, to recap, allocation and distribution is important for risk management and understanding the risk of a cryptocurrency. Allocation and distribution do not apply to fair large cryptocurrencies, but only to pre-mined cryptocurrencies which are minted before the network is open to the public, like you and me. Next up, we are going to talk about fundamental analysis and due diligence, which are two of the most important processes to go through when researching potential investment in the crypto sphere. So, see you in the next video. Hi, and welcome back to another video with Crypto Upscale. In this video, we are going to be discussing market cap and token metrics. When considering a new investment in a token, the goal for 99% of investors is to buy low, sell high, and get profits. As a result, the first metric you are looking for is the current price of a cryptocurrency. The most popular websites for researching price history and the other metrics that we are going to be discussing in this video are CoinMarketCap and CoinGecko. In these sites, you can find information on the token or coin, like markets to trade, as well as links to the token's website and white paper. But more on that later. In this video, we are going to focus on explaining market capitalization, the different supply metrics, and how these can impact the price of a coin or token. You may hear that low market cap tokens have higher upside potential, which is partially true, but they are also riskier to be manipulated. Market capitalization is basically the total worth of a project, which is calculated by multiplying the circulating supply of the token with the current token price. Circulating supply is the number of coins or tokens currently in the market for investors to buy and sell. So, based on the definition of market cap, you can see why lower market caps have higher upside. Lower market caps need less capital to increase in price compared to higher market caps, and this is why people can manipulate these tokens. Malicious actors can buy large quantities of low cap tokens and then organize pump and dump groups to pump the price by tricking people into buying and then dumping their holdings to the people who just tricked. Higher market caps, on the other hand, like Bitcoin and Ethereum, are not susceptible to pump and dump, since they require a much larger capital base to flow in for the price to increase or decrease. Therefore, you should be very skeptical before buying any coin or token which was shipped to you from a Discord group or Reddit group or any other online forum. In CoinGecko and CoinMarketCap, you will also find information like the total supply, max supply, and 24-hour volume. The total supply is the current total supply of a token or coin, which may or may not be in circulation. Max supply is the maximum number of tokens or coins that will ever be minted. A low max supply usually means a scarce token, making it a potential long-term investment, while an empty max supply means that the token can be minted whenever there is a need for it. For example, Dogecoin. 24-hour volume is the total amount of tokens in US dollars that were traded over the last 24 hours across all markets. A high volume shows strong liquidity, which means it will be easier to buy or sell that specific token, whereas a low volume, it may mean that selling or buying a cryptocurrency might take some time. Finally, Bitcoin dominance is an important factor which you can check from any of these sites. It is basically the market share of Bitcoin from the total crypto market. A lower Bitcoin dominance usually signals the beginning of the alt season, where altcoins spike in price, whereas an increasing Bitcoin dominance signals that most investors sell their altcoins for Bitcoins, which in turn reflects on the price. To conclude, when researching an altcoin as a potential investment, always check the market cap and the supply metrics. Low market caps mean higher potential but higher risk, whereas higher market caps mean lower potential but a safer long-term bet. Supply metrics will give you an idea on how scarce a cryptocurrency can be in the future, making it a valuable investment in the long term or a short to mid-term trade opportunity. I hope you now have a better understanding on market caps and supply metrics. Now jump on to these websites and start your research, or stay with me as in the next video we will be digging into allocation and distribution. Hi and welcome back to another video with Crypto Upscale. In this video I am going to show you how to check altcoins fundamentally, how to do your due diligence, and then decide whether a project has the potential to be something special or if it can go down to zero and cost you your entire investment. In trading and investing, we have two types of analysis: fundamental analysis and technical analysis. Technical analysis is the art of analyzing price charts and identifying patterns for a specific trend or a price reversal. On the other hand, fundamental analysis is the analysis of the project as a whole, the health of the project, its market, and the competition. In other words, fundamental analysis is one of the most important processes in the world of investing. Doing technical analysis on a project without good fundamentals is just speculation. It's like playing a game of cards, hoping you will get lucky. Fundamental analysis needs to be also backed by doing your due diligence. To put it simply, due diligence is the process of confirming facts or details from more than one source. In the world of cryptocurrency, fundamental analysis and due diligence can be a powerful ally when it comes to finding your next $1 million cryptocurrency. To make it easier for you, I have come up with 7 steps to follow when doing your analysis. So let's go get it. Number 1. Check if they pass the legal standards. Number 2. Investigate their website. Number 3. Check their social media presence. Number 4. Deep dive into the team and their strategic partnerships. Number 5. Study the white paper. Number 6. Try their product. And number 7. Spot any red flags. So now let's break this down one by one and understand how to go through all these steps in more detail. Check if they pass the legal standards. In the first video of this section, we explain the difference between coins and tokens. Except from their blockchain and the usual use case, most of the regulators are treating coins as currencies, since they are native to their own blockchain, whereas the rest of the tokens are treated as stocks. This means that for tokens to be legally eligible for trading or investing in different countries, the parent company should fill in all the paperwork and pass through all the regulatory process in order to be legal. Failing to do so may lead to action suits, which eventually will affect the price and the company itself, like it's currently happening with XRP and the ongoing SEC lawsuit. Google is your best friend in discovering legal dirt, but if you need any assistance, then cryptoratingcouncil.com is a great rating website that can help you with that. Number 2. Investigating their website. Each token is the native cryptocurrency of a specific project with a specific use case. It can be a decentralized exchange, a payment platform, a lending protocol, or anything for that matter. You can find the official website using Google or using the link in the bottom of the coins or tokens page in CoinGecko or CoinMarketCap. The website should contain information about everything you need to know, such as the purpose of the project, which we are going to be analyzing in a different video, the team and technology behind it, social media links, as well as a link to the white paper. When visiting the website, check if it's well built, if it looks professional, and if the links are actually working. You will be surprised on how many times I found a dead link or a website that timed out while trying to view it. Checking their social media presence. All crypto projects should have an official announcement channel such as Medium or Bitcoin Talk Forum. This will be the channel where all the official announcements from the team should be coming from. Twitter, Facebook, Telegram groups, even Reddit forums are also showing social presence. You can always use Google, but with so many scam pages and groups nowadays, I prefer to use the links from their official website. Check if they have a growing community, if they post on a daily basis, if they interact with the community, and in general, if they are active. This is an example of a project that haven't posted anything for 2-3 years, so without even researching it to see if they still have a working product, I wouldn't be investing in it. And this is a project with a growing community, interacting daily with the community, and posting updates multiple times per day on the current progress. Which one would you choose? Deep diving into the team and their strategic partners. The team behind the product is the backbone of the whole company, while any big players announced as partners can boost the project's price. You should be able to find the team behind the tokens product in their official website, white paper, or through their official announcement channels. There were cases where a Chinese actor with false credentials was added as the CEO of a tokens product, and it took a couple of months for someone to identify and expose the project as a scam, and that is why you should be deep diving into the team. Checking their LinkedIn accounts or searching them in Google can help you to cross-check their credentials. Once you are satisfied with the team results, it's time to check their partners. Companies like IBM or Coinbase Ventures tend to partner with cryptocurrency companies. This giant can help pushing a product to mass adoption, but also this must be cross-checked. Search in Google the two companies and see what results you get. For example, Orion Protocol has partnered with Cody according to their official Twitter accounts. A quick search in Google News can verify this as well. Studying the white paper. The white paper is a very detailed and technical documentation about everything that is project related. The white paper is written by the founders and developers of a project and includes token metrics, facts, equations, diagrams, and other project details. If you are technical, then studying the white paper can help you get a better understanding of the project as a whole, but if you are not technical, then don't worry about it. You just need to make sure that the white paper actually exists and includes all the project details. Number 6, trying their product. What's a better way to evaluate a product than testing it yourself? Your potential investment can be a lending protocol, a payment application, or a gaming platform. Your best bet is to try it out. Check how easy it is to use, how user-friendly, and if you can benefit from using their system. Another important factor you need to consider are the fees. In today's crypto markets, Ethereum fees are very high due to the network traffic. If you have $1,000 to invest and you end up paying 10% of that amount on fees, you might need to reconsider your investment. Finally, spotting any red flags. Everyone investing in cryptocurrency jumps in hoping that their coin or token will only move up, but any negative news can trigger a lot of sell orders, which will cause the price to tumble. To avoid this, you need to do your research and try to search for any red flags. Start by making sure the project is on track. Did they meet the timelines they set during the roadmap? Do they still have a working product? Do they have a plan and a strong roadmap for the short and long-term future? These are all questions that you need to be able to answer positively in order to have a fundamentally strong project. Next, Use Google to run the acid test. The acid test is where you search for potential negativity on the internet regarding your token or coin, or feud as they call it, and cross-checking from multiple sources if this news check out. For example, you may Google your coin name space scam or coin name space feud and see what you come up with. Remember that one site mentioning that your favorite cryptocurrency is a scam doesn't necessarily make it true, as it can be people trying to bring down the price to be able to buy cheaper. Therefore, make sure you cross-check the red flags from multiple sources. By following these steps, you are already better off than most of the crypto investors out there, and if your token or coin has passed all the tests, then congratulations, you have a strong fundamental cryptocurrency. So, we just covered the steps to a strong fundamental analysis in under 10 minutes. Stay tuned, as in the next video, we are going to be talking about inflation investing, which is very relevant if you are a long-term cryptocurrency investor. Let's jump in. Hi, and welcome back to another video with Crypto Upscale. In this video, we are going to analyze vesting and inflation, which are two economic factors that long-term investors need to keep in mind. For traders and short-term investors, these factors will have little to no impact on the price of a token or coin in the short term. So let's get to it. Vesting applies to pre-mined cryptocurrencies and refers to how the coins or tokens are to be allocated over the coming months or even years. As mentioned in previous videos, pre-mined cryptocurrencies usually lock up a percentage of the total supply and allocate that percentage within the developers, team, and strategic investors, which help them build the product by providing the funds and expertise. Vesting is carefully designed to release locked cryptocurrency through a period of many months or years to avoid big sell-offs in the markets, or dumping as we call it. When you see a project that unlocks a big percentage of the total supply at once, I would personally stay away, since the owners of that unlocked cryptocurrency can market sell their coins or tokens, which could result the price plunging into the abyss. Now, inflation refers to the purchasing power of a cryptocurrency over a long period of time. Just like fiat money that do not have a max supply, they are inflationary and lose value over time. The same applies for cryptocurrencies that do not have a max supply. Decentralized finance tokens, aka DeFi, that do not have a max supply and give the owner the chance to stake their tokens to earn passive income in the form of tokens, have usually an annual inflation rate of 5 to 50%, and this happens to incentivize the network validators to earn more cryptocurrency by staking and locking their coins or tokens for a period of time. Some projects like Polkadot adjust their inflation based on the participation in staking to maintain network security. In the case of these DeFi tokens, the market experts advise, do not buy it, earn it. Deflationary coins and tokens, on the other hand, are the ones who have a maximum supply set. There will never be more than the maximum supply. For example, there will only be minted 21 million bitcoins, which may be one of the reasons that Bitcoin price is surging. In these sort of tokens or coins, the human error can also cause the deflation rate to increase, since many cryptocurrency owners forget or lose their seed phrase over time and do not have any way of accessing their wallet funds. In addition, some companies intentionally burn tokens to reduce the current supply and cause deflation to a coin or token. Summing it all up, if you are a short-term trader, vesting and inflation probably won't be affecting your investments, but if you are a long-term hodler, then you might need to make sure that vested tokens do not have big percentages unlocked and that the inflation or deflation level is well within your investing strategy. Hi, and welcome back to another video with Crypto Upscale. In this video, we are going to be discussing the concept of staking, which can also be the main utility of a project. In technical terms and according to Wikipedia, proof of stake is a type of consensus mechanism by which a cryptocurrency blockchain network achieves distributed consensus. For regular people like me, this didn't make a lot of sense to begin with, so I decided to analyze the concept and come up with my own definition in plain English for everyone to be able to understand. In simple terms, staking or proof of stake concept states that a person can mine a specific coin or token depending on how many of those coins or tokens they own. When you stake a cryptocurrency, you are staking as either a validator or a delegator on the blockchain. A validator is a node that participates in the consensus of the block, whereas a delegator basically delegates their stake to a validator for indirect rewards. The amount of cryptocurrency you stake usually has a lockup period. For example, people staking Akash network tokens on BitMax have a lockup period of 21 days, which means that if they choose to undelegate their tokens, they need to wait 21 days before they can sell them in the markets. However, they can choose to unstake their tokens instantly for a 5% fee. In return, they will earn an amount of Akash network tokens depending on the APY or annual percentage yield return rate. Let's say you have 1,000 of those tokens staked and the APY is 43%. This means that after 1 year of having tokens staked, you will have 1,430 Akash, but if you stake on BitMax, where there is daily compounding, you will end up with 1,536. Pretty cool, right? Coins or tokens with a big percentage of their supply staked often lead to higher prices as people cannot sell their tokens due to lockups. Cryptocurrencies like Cardano can be staked without lockups with a lower APY rate, which means that if Cardano price goes up, Cardano owners can unstake their tokens and sell them anytime to realize on their profits, resulting in the Cardano price going down in the short term. In general, proof of stake tokens or coins usually have staking as their main utility. In other words, the project's use case is to have their tokens staked. In decentralized finance, staking is a way of people to earn passive income in the form of cryptocurrency, and in return, they lock up their holdings as a validator of the blockchain or as a delegate. So, if you want to stake your cryptocurrency, all you have to do is find a DeFi token with a high APY rate and start earning some passive income. Be careful of lockup periods, as a high lockup period will keep you from selling in the profits if the price goes up. If you trust and have faith that a specific project is destined for greatness and you want to accumulate as much as possible by paying as little as possible, then buy more and earn the rest of the tokens through staking. It's that easy. You can use DeFi Pulse or LoanScan to check the rates of return for any of your preferred tokens, as both websites are very easy to navigate and both provide reliable information. So, I hope you now have a better understanding of how staking works and how you can use staking to earn some passive income in the form of cryptocurrencies. In the next video, we will be diving into the altcoin use cases and how you can use the investment checklist for your advantage. So, stay tuned. Hi and welcome back to another video. This is Nick from Crypto Upscale, and in this video we are going to be discussing the investment checklist, project use cases, and I'm going to teach you 3 steps you can follow to deep dive into the project you are researching. If you didn't download the investment checklist already, go ahead and do it now from the resources section. I'll wait. In previous videos, we discussed how you need to visit the website of a cryptocurrency, identify their purpose, and read the white paper. This is very general, and in this video, I'm going to give you a more concentrated approach on what you should be on the lookout for. So let's do it. Step number 1. What does the coin or token supposed to do? Is it trying to bring world peace, or is it trying to reduce inflation? Is the goal realistic? Do you believe in it? A project without a purpose is destined to fail. So the first step is to identify the actual use case of the cryptocurrency and do your research on the web if the problem it's trying to solve is valid, if it's an actual problem, and if others have tried before. Step number 2. Who is building it? A project needs to have a clear goal, but it also needs to have a team that will help them get there. Does the team qualify based on their credentials? You can find all this information in their website and the white paper. Step number 3 is to identify the competition and see where does your potential crypto investment stand in comparison to that competition. If you find out that they are just copying someone else's use case who is already a market leader, then it doesn't look like a good idea to invest in them. How do they differentiate themselves from the competition? Do they have the same target market? And if not, how big is their target market in comparison to that competition? The white paper, official website, and Google, and also the investment checklist you just downloaded are your best friends in answering all these questions. You can use a copy of the investment checklist to rate your potential investment as a whole. Answer as many questions as you can inside the checklist, and then once you are finished, take a step back and rate how many positive and how many negative answers you have regarding your altcoin. If the negative answers are more than 10%, then you might need to reconsider your investment. So I hope you now can go through a project and start your own research, but if you still have questions, then jump in the next section as we will go through a practical example where we are going to take a token through the journey of research and decide in the end if it's worth investing in it or not. So stick around. Hi, and welcome to the last video of our course. By now you should be able to get into discussions about Bitcoin and blockchain, know how to identify the potential in any new cryptocurrency, doing your own research, and be ready to go out there and create life-changing wealth through crypto investments. In this video, I want to stress out what is never being stressed enough. That is, portfolio diversification and taking profits. Before we start, I want to mention once again that this video as well as the rest of this course are for educational purposes only, and I am by no means a financial advisor, so this is not a financial advice. When people are talking about portfolio diversification, they are most of the times talking about keeping in your portfolio bonds, real estate, indexes, low-risk stocks, and penny stocks. For the sake of this video, I will go ahead and assume that you, like me, have separate portfolio containing only cryptocurrencies, and this is the portfolio we are going to be diversifying. In general, portfolio diversification is another phrase for don't keep all your eggs in one basket, which translates to minimizing your risk, doing your risk management, call it whatever you want. I call it portfolio balancing based on risk. As we discussed in the beginning of this course, higher market cap coins and tokens need more capital to flow in order to have a meaningful price change, meaning that higher market cap cryptocurrencies such as Bitcoin and Ethereum have lower risk than low market cap coins and tokens. Taking this statement into consideration, you could have 30% of your total portfolio into Bitcoin and Ethereum to minimize your risk. Then another 30% could be medium market cap cryptocurrencies with higher upside and higher risk. And then the last 40% could be very low market caps, of which you are looking at the highest risk of going down to zero value, but also they have the highest potential in multiplying by 100 and seeing your investment skyrocket. So after you diversify your portfolio, depending on your risk strategy and expected profits, the next thing I can't stress out enough is to take profits. As history has shown time and time again, all the markets come in full circle and markets crash faster than they rise. So taking profits is a must-have strategy before investing. What I do is take profits slowly as a cryptocurrency rises in price, and once I take out my initial investment and have nothing to lose, I sit back and wait until I'm satisfied enough with the numbers so I can take profits on the way down. Your strategy could be different. You could have a specific percentage in mind where you are going to take all your money out. You could write a market circle and wait for the next bull run, or you could say that when my portfolio hits a specific amount of US dollars, I'm going to market sell everything. That's up to you, and in reality there is no correct or wrong way of taking profits as long as you do take profits. Being greedy and think that your cryptos will go up forever is the easiest way of getting wrecked, but if you keep a balance between taking profits and diversifying your portfolio, then I am pretty sure you will be building life-changing wealth very soon. So, I hope you liked and enjoyed the course, and you are now ready to find the next $1 million cryptocurrency. In the next section, I have for you a course recap quiz which you can take in order to see how much you have learned in this course. Now go out there and crush it. This was Nick from Crypto Upscale, and any question you may have, feel free to reach out to me on Twitter at Crypto Upscale.